Hi and welcome. My name is Leah Bennett. I'm the president of Westwood Wealth Management, the Houston division, and I'm also one of the portfolio managers on several of the strategies we run within wealth management. With me, I have Matt Lockridge. Matt is a senior vice president, co-director of equity portfolios, and a senior portfolio manager, and is very involved with our large cap value strategy. Welcome, Matt.
Leah, great to be here.
We thought this might be a great chance to have a conversation about a few topics that we keep hearing, getting questions from our clients, China, supply chain, and inflation. The latter two topics, I think, are clearly related. So we might start with China, which is very topical right now. And I'm curious what your thoughts are regarding rising risks in China, whether we're talking about Evergrande or a government that's really becoming more communist directed. How do you think these risks are impacting a lot of large caps companies at this point?
There's a lot going on around the world. China, I think it is very interesting to watch the pivots that this country is making. And what I mean by that is over the last several decades, really, 30 or 40 years now, there's been this, trend towards capitalism, allowing businesses to flourish within that country. And I think more recently we've seen Beijing try to attack some of the negatives or the downsides of that. What I mean by that is some of the corruption that is starting to pop up, and also some of the ideology and really run counter to their communist rule. And so if you listen to President Xi and read some of his writings, it's almost as if capitalism was more of a temporary stance, essentially to pull citizens out of poverty, to grow their middle class. But now they're transitioning more almost towards a Mao socialist type vision. The state clearly still wants to control money flow, but they want to set tighter standards and parameters on entrepreneurs and on businesses, and generally control the economy more than they have over the last couple of decades. And I think you're seeing them restrain some of the larger businesses. When you think of companies like Alibaba and their founder Jack Ma, we're seeing what they did to the very hot for-profit education sector, where they're essentially nationalizing those companies. And now you're seeing them try and rein in the housing market and the rapid inflation you're seeing there. And that's really what's uncovered this Evergrande situation, which I'm happy to talk about more. I think the other thing that's interesting in Xi's writings, he is talking a lot about common prosperity, and I think the U.S.'s initial reaction to that was that, okay, the two large economic superpowers will prosper together, the U.S. and China. But I think what we're learning is there's more underlying meaning to that, and really an internal meaning, which is essentially a redistribution of wealth within their country. And I think that poses risk clearly to China, but also to companies outside of China. The risk to China is that stance really suppresses entrepreneurial energy and innovation. There's been a number of very successful large companies that have come out of China over the last couple of decades. When you think of Tencent and Alibaba and others, the impact to domestic companies, large cap companies, for example, is really that not only will they have to toe the party line in terms of communication, but they could be asked to do more if they have a presence there. It could be providing user information for their services. It could be hiring party officials as employees. It could be selling stakes in their businesses to state-owned companies. So all of this could be in an effort to help Beijing achieve their goals. But overall, I think this will have a dampening effect on their economy, and that's how we'll see it internally in our domestic companies' earnings. China and other emerging markets have really been a positive geographic mix in terms of increasing their growth rate. And as that economy slows, we'll have to make sure that expectations are ratcheted down for the growth coming out of that country.
Yeah, it's a really interesting trend, even if I'm thinking about a lot of the news that's coming out around crypto and the big controls that you have going on in place with China. Again, it's decentralization. They just do not like anything that's away from the party. So it's going to be interesting to see how that continues to materialize over time. Another question that I've got, if I know one of the big concerns when we're talking to clients that they certainly have is the rise in debt that we've seen. And really, we've seen it globally. So if you think about China, if you think about sovereign debt, since 2008, two-thirds of the debt globally has been produced by China. So China has become more and more dependent on stimulus and on the government themselves. And so I think part of when Evergrande broke, when the crisis kind of broke, there became a lot of concerns about, is this a systemic risk? And I'm kind of curious what your thoughts are around that particular topic. And also, if you, I know you have great background with banks, and kind of what your thoughts are as far as how the U.S. Banks or banks in general are capitalized versus 2008.
Sure. No, great questions. I would say on the latter question, our banks are in much better financial footing today than they were in the 08, 09 financial crisis. And one way we measure that is through the annual stress tests, which we do now on the largest financial institutions in the country. So if you look at the most recent test as of June 2021, the top 19 largest financial institutions, we aggregate all of their assets and liabilities. And right now they have 13% tier one common equity ratio. And so when they do their severe stress tests, where they do things like assume that unemployment goes up almost to 11%, they assume that real GDP declines by 4%, what happens to these banks? And basically that ratio goes from 13% down to 10.6%. And the minimum requirement is 4.5. So again, in a much better position, even under an extreme distress situation, than the minimum requirements or where we were in 2008, 2009. And then when you think about Evergrande, and is that an issue that we should be concerned about on a broader scale? We like to remind folks really the size and show a relative equation. So Evergrande has a little over 300 billion in liabilities. To put that in perspective, Lehman had over 800 billion in today's dollars. So some folks are talking about, is this the Lehman Brothers event for China? Well, Evergrande is significantly smaller. And even taking that further, if you compare Evergrande to our largest financial institutions, for example, Bank of America has 2.5 trillion in liabilities. So we're talking, significantly larger U.S. financial institutions than what we're seeing from the distress in Evergrande. So just something to watch. I mean, clearly, the bigger issue for the global stage would be if this is just the tip of the iceberg, and are there other developers which are also under distress that we're just not seeing yet? So something we're watching. But Evergrande in and of itself, we don't feel would have serious repercussions across domestic companies.
And hopefully it is a more contained situation, but just to pivot off your comment about could this be the tip of an iceberg? I mean, are there other situations out there? How do you discount that risk into valuations and when you're looking at companies and making investment decisions?
Sure. No, that's another great question. I think, first, we tried to understand the expectations in growth coming out of the China region. And we want to make sure that those are calibrated appropriately. So what are the expectations built in to earnings estimates for our companies? That's number one. So if we see a deceleration in growth, we want to make sure that our assumptions are appropriate and reflect that. And secondly, in financials, we want to understand as best we can the counterparty risk. So at this point, given it seems to be somewhat contained, we feel okay about our financial holdings today, but again, are watching to make sure that this doesn't spread and there's other companies in distress that are about to pop up.
And to pivot a little bit, what do you think? What are your thoughts right now about the U.S. market? I know we're about to go into earnings season, and we've had a few companies pre-report, but what do you think about the market right now?
Sure. So I think we got some recent news from the Fed, and so I think reading some of the reviews following Jerome Powell's press conference and from the Fed's press release, some took it as really of a more hawkish stance. I guess my thought on that was it really wasn't as much hawkish as in line with expectations on tapering and when the first interest rate increase may occur. But what was unusual was the amount of specifics he really got into. And so, he talked about the next job report and how, unless it's very bad, tapering will likely start in November, and tapering will go through the middle of next year, which then sets us up for the first interest rate increase in late 2022 or early 2023. And that generally aligns with the dot plot that they also provide, where we had 9 voting members talk about feeling comfortable raising rates in 2022, another 9 saying they would prefer to wait until 2023. So you kind of take the middle of that range, that sets up for the first increase at the end of 2022 or 2023. So all of that was generally in line with consensus from our standpoint. And therefore, there shouldn't be a big market impact from that. I think the Fed aside, the economy's in a pretty good position right now. We've had some very good corporate reports recently. If you look at, for example, in the consumer space, the retailing group. So within the S&P 1500, there's 108 retailers in the index. Now, 40% of those give full year guidance. And all but one of those have raised their numbers year to date through the end of August. So the demand trend that retailers are seeing continues to be very positive and, in fact, better than expected when they gave guidance. We also got some recent commentary from a large restaurant operator in the casual dining space. When we look at their same-store sales or how their restaurants are doing that were around both this year and last year, they're up over 45% year over year. Now, you could say, well, maybe there's some goofiness with last year being impacted by COVID, and of course, the growth rate's going to be really strong. But if you look at their numbers versus 2019 or pre-COVID, they're now guiding sales to be up 7 to 9%. So we're seeing very strong, even against pre-COVID numbers in the restaurant space as well. So, to us, with the consumer being such an important part of the economy, hearing corporate fundamentals as good as they are like that, it gives us a lot of confidence that the market's in pretty good shape.
I was reading some research the other day that was discussing the fact that consumer spending is actually 11% higher than it was in 2019. So again, back to the strength, I think that a lot of people maybe don't fully realize that's really encouraging for a backwind for earnings moving forward. And then the other thing that really gives me a lot of optimism, we've seen, beneath the surface, all these violent rotations between growth and value, and it is encouraging growth that kind of taken over when the Delta variant really became pretty prevalent. But now you're starting to see interest rates start moving up and starting to see the cyclicals and value stocks start outperforming, which is a good sign for the economy as well. So I'm also encouraged about what the outlook is. Just to switch a little bit, and we were talking about that there's been some earnings pre-releases. This kind of gets into the second 2 topics that I mentioned, supply chain and inflation. So we've had some new data points as it relates to both these topics. So I'm kind of curious, both FedEx and Nike, just as examples, have mentioned struggles that they've had in this area. Can you talk about that a little bit, and what are your views?
Sure. Yeah, I know the supply chain issues that we're all hearing and reading about, these are real. I mean, we are hearing this from our companies really across all sectors. There are a number of companies in the industrial space that have said, we can't get parts at any price, let alone just having to pay up. We just can't simply get, we can't get the parts. In terms of FedEx specifically, I think it was interesting because, we've all heard about what's going on in the semiconductor landscape and other parts, but this, for FedEx, it was really more of a labor issue. where they gave the example that within their ground segment in Portland, Oregon, they're running at about 65% of the staffing they need to operate normal levels of volume. And so what they're having to do is reroute these packages because they show up in Portland and there's just literally no one there to process them. So having to divert almost a quarter of their volume that would go through that facility, it adds costs in terms of labor, in terms of miles driven, and just a lot of efficiencies in their chain. And so that was the reason really they had to pull their earnings guidance down for the full year, even though the top line, the demand side was strong. It was a cost issue, and specifically labor for FedEx. Now with Nike, they had an issue where it wasn't demand. They felt that their demand strength and the consumer was strong. It was really elevated transit times coming from Asia to the ports in California and then out to their retail partners. So there's a number of ships that are anchored off the coast of Long Beach. Basically, we have close to 70 ships anchored out there now, where there's usually only one. And then there's labor shortages at the dock, at the ports. There's labor shortages in the freight networks, and all of that is adding increased time and expense for Nike. The other issue that Nike pointed out related to COVID was their footwear facilities in Vietnam. So that is a huge and important manufacturing partner for them. And basically since July, that government has had mandated shutdowns in their footwear factories. That's just added, again, increasing costs and time for Nike. And so, again, it was more of a supply issue, being able to get goods to their retail partners, not necessarily a demand issue. But again, those bottlenecks are real.
I think this is also a good example of where a lot of these trends obviously feel really bad. I mean, the consumer's paying a higher price, which is in a lot of people wonder, is this transitory? Is it structural? There's all these debates, but also these fits and starts around COVID also is what's creating opportunities. And so it's partly why the correlation between securities is lower right now, which is fantastic. So I always believe there's opportunities in the market. So from your perspective, who are some of the winners in the global labor shortages and the supply chain challenges?
Sure, yeah. So, one way we've tried to attack this is invest in certain sectors where some of these bottlenecks and supply chain issues can cause an increase in their underlying product, which in terms of pricing, which benefits the manufacturers or the production companies. And so, one area that comes to mind right away is energy, where any supply bottlenecks increase the price of the commodity, and the E&P companies benefit from that. So that constraint in supply has helped our energy holdings, specifically in oil and gas. Another thing that we've tried to emphasize is you want to be invested in companies with strong pricing power that can pass through these costs from the supply chain issues. And so, one important signal we're looking for are companies with high gross margins. That's generally a signal that they have pricing power, and also scale. So if you think about a supplier that is having to really think hard about allocating their inventory across their customers, you're typically going to go to your largest, most important customer, and those customers that have the best sell-through. And so when you think of the retailers, for example, that are trying to get product for their customers, those retailers that have the scale, that buy in mass and can get it through to their end customer the fastest, are the ones that are going to get the goods. So generally, the larger cap companies would be more advantaged than small cap names.
I also think about all these companies. Restaurants come to mind, but there's a lot of companies in the space that have been utilizing robotics differently and had a stronger uptake in order to deal with some of the labor issues. So it's going to be interesting to see some of the permanent changes that occur from some of these trends as we're coming out of COVID. So a follow-on question: when do you think we'll see some sort of normalization? Kind of the magic question. And on this topic, we've talked around semiconductor shortages. There's been a ton of press. I'm also curious what your thoughts are there. as it relates to that normalization, and when we'll have some sort of relief as it relates to semiconductors.
Yeah, that is the million-dollar question. I think for the broad semiconductor space, we're likely pushed into the middle of 2022. And if you listen to the semiconductor companies with a lot of auto exposure, they're pointing more towards the end of 2022. So it's going to take a while to get fully normalized. And again, it's not just auto; it's in a number of different areas, consumer electronics, et cetera. So it's hard to say exactly, but it's definitely longer than we thought initially. We kind of thought the end of this year you'd start to see more normalization, but it almost seems like in the last few weeks things have gotten worse. So again, we're thinking mid to late 2022 before you see true normalization.
And when we're talking about normalization, I guess the final question I have for you, which is a topic I think everybody's discussing, is this transitory or is it structural inflation? Transitory being this is temporary, and when COVID is semi addressed, when we have enough a large enough percentage of the population globally vaccinated, will we go back to a more normalized level, or what is the outcome to the economy afterwards? I'm kind of curious what camp you're in and what your thoughts are on that topic.
Sure. No, another interesting question, just how to think about inflation. How long is this going to last? I think there really are a lot of cross currents right now on the whole inflation discussion. I think, there are clearly short-term inflationary pressures, everything which we just talked about, supply chain, semiconductors, et cetera. I also think there are short-term deflationary trends at play as well. When you think about some of the behaviors that we as consumers adopted during COVID, during the lockdown, and how some of those may last longer than we initially thought. And what I mean by that is, if we eat one more meal than out, there are deflationary aspects to that. Food at home is cheaper than food away from home. Or if we make one fewer trip to the office, that has a short-term deflationary impact. Now, I say short-term because unless we take one fewer trip the next year, that deflation kind of goes away after that step down. But there are those shorter-term issues that I think the economy is dealing with. I also think there are longer-term deflationary factors at play, given what we just went through with COVID, mainly around the whole concept of work from home. And all of a sudden, you have an increase in the labor supply for any given company. So if you're a technology company in Silicon Valley looking to hire an engineer, you now are not just looking in Silicon Valley. You're looking really globally for that talent. So you have an increase in labor supply without the same increase in demand. And so that will have longer term impacts. And I think some of that is what the bond market is thinking about as they look out 10 years, 20 years, and calibrate interest rates accordingly. Now, the big unknown is what we're seeing right now in short-term wage pressure and how long that lasts, because wages are one of the stickiest components of inflation. So if that just lasts longer than anyone thinks, then there will be added inflationary pressure as we move out. So that's really what we're watching, wage pressure right now and how long that's lasting to really get a gauge for inflation long term.
That's really an interesting point in time right now. And then the other, back to your deflationary thoughts, the other thing I think about is corporate travel. Corporate travel is forever changed, I believe. It's interesting. I think you wouldn't think twice about flying across the country for one or two meetings and flying back the next day, which is not the most efficient way to travel. And I think people are just going to be more thoughtful about how they're moving around, much more so than we were a couple of years ago. So I do think there's these interesting dynamics. And if you think about technology in general, technology is a deflationary force. So, but it is going to be interesting on the timing of these for sure.
Yeah, no, I completely agree. I think there aren't probably more business travel in the future, but I know a lot of people that will do less business travel. And so I think you're exactly right.
Yeah, I think quality of life is something that people are really thinking about. Again, not driving as much, and what does work-life balance look like? It's going. Like I said, I think it's interesting to see the ramifications of this longer term, and I just struggle with the fact, we've really shut down the U.S. economy or the global economy for a year and a half now, and we're restarting, and the world has to look different.
Agree.
Thank you so much, Matt, for joining us for the conversation. Again, I think we've recapped that there are some risks out there. Certainly, China is something that we're watching quite a bit. We do have some concerns around the supply chains, and then certainly this debate around inflation, whether or not it's transitory or structural. And it will be interesting to see how this plays out during earnings season. But we're still fairly optimistic about opportunities, and appreciate you guys joining us. Thanks so much for your time.